What if I told you that the greatest book ever written about trading isn't a textbook? It has no charts, no formulas, and no secret indicators. It's a story. A story about a boy who ran away from home with a few dollars in his pocket and went on to win and lose fortunes that would be worth billions today. A man who single-handedly stared down the most powerful forces on Wall Street and bent the market to his will. A legend whose ghost still haunts every trading floor in the world. This isn't a story about safe, long-term investing. It's not about diversifying your portfolio or planning for retirement. It's about the oldest and most fascinating game in the world, the raw, high-stakes art of speculation. It's about pitting your judgment, your courage, and your discipline against the collective mind of the crowd. It was written over 100 years ago, yet it reads as if it were ripped from today's headlines. How could a life story of a trader from the gaslight era tell you more about the psychology of a Bitcoin bubble, the madness of a meme stock frenzy, or the hype around Tesla than any modern analysis? The answer is because the market never changes, because it is built on the one thing that never changes: human nature. Welcome to Capitura. Today, we are opening the book that is required reading for virtually every top hedge fund manager and professional trader on the planet. We are going to the mind of the most legendary speculator who ever lived, through the pages of Edwin Lefevre's masterpiece, Reminiscences of a Stock Operator. This is not just a book summary. This is a journey into the heart of the game itself. Stay with us, because the timeless wisdom in these pages is a key to understanding not just the market, but yourself. Introduction: the ghost and the machine. First, a crucial point of clarification. Reminiscences of a Stock Operator, published in 1923, was written by a journalist named Edwin Lefevre. But it is not about Edwin Lefevre. The book is a thinly veiled, fictionalized biography of the single most famous, and perhaps the greatest speculator in history, Jesse Livermore. The narrator and hero of our story, Larry Livingston, is Livermore in everything but name. His triumphs, his failures, his philosophies, they are all Livermore's. Jesse Livermore was a living legend, a titan of an era before regulations and computers. He was a man who traded with his mind, his gut, and mountains of cash. He famously made a fortune shorting the market during the Great Panic of 1907, a feat he would repeat during the infamous crash of 1929. He was blamed by the White House for the crash and personally begged by the great J.P. Morgan to stop selling. He was the original market mover, the Great Bear of Wall Street, a man whose actions could make or break entire industries. But he also lost his fortune multiple times, going from lavish yachts and private rail cars to complete bankruptcy, only to claw his way back again. His life was a testament to both the incredible possibilities and the profound dangers of the market. So why is this 100-year-old story still considered the Bible for modern traders? Because Livermore's true genius was not just in making money, but in his profound understanding of market psychology and, most importantly, his own psychology. He learned, through incredibly painful experience, that the market is a giant mirror reflecting the emotional weaknesses of its participants. Hope, fear, greed, and ignorance. These are the forces he learned to master in himself and exploit in others. Think about the world we live in now. A tidal wave of new participants has entered the market through commission-free apps like Robinhood. They are armed with instant access, but often lack the emotional discipline Livermore spent a lifetime acquiring. They get swept up in the FOMO of a cryptocurrency bull run, buying at the top because they can't stand to miss out. This book explains exactly why that impulse is so powerful and so destructive. We witnessed the GameStop saga, where a legion of retail traders on Reddit organized to fight Wall Street. They were driven by a powerful narrative, a sense of community, and a desire to see the little guy win. Livermore would have understood this perfectly. He knew that markets are moved by stories and that the crowd is a powerful, emotional beast. But he also knew that, in the end, the price must be reconciled with the underlying reality. Even for those on a more conservative path, like the FIRE movement, Livermore's wisdom serves as a cautionary tale. While FIRE followers focus on passive investing in ETFs, Livermore's story highlights the siren song of speculation that can derail even the most disciplined long-term plan. His life is a vivid illustration of what happens when the desire for quick, easy money overtakes prudence and patience. Reminiscences of a Stock Operator is a masterclass in the timeless principles of speculation. It's not a how-to guide. It's a series of hard-won lessons, paid for with millions of dollars and immense psychological pain. It teaches you that the tape, the price action itself, is the ultimate truth. It teaches you that the big money is not in the buying or the selling, but in the sitting. And it teaches you that the greatest enemy you will ever face in the market is not the smart money or the manipulators. It's the fool that resides within your own heart. In the chapters that follow, we will walk side by side with Larry Livingston on his incredible journey. We will celebrate his epic victories, feel the sting of his catastrophic defeats, and absorb the profound wisdom he extracts from each experience. And after each chapter, we will connect his timeless insights to the market you are facing right now. This is more than a story. It is an education in the art of speculation, from the greatest to ever play the game. Chapter by chapter breakdown. Chapter 1. Our story begins not on the grand trading floors of Wall Street, but in the smoky, frantic world of a bucket shop in New England. It's the late 1890s, and our narrator, a young teenager named Larry Livingston, has just run away from his family farm with a few dollars from his mother, determined to make his own way in the world. He gets a job as a board boy at a stock brokerage office, where his only duty is to chalk up the stock quotes as they come in over the telegraph wire. This is where the legend of Jesse Livermore begins. Most people would see this as a dead-end, menial job. But for the young Livingston, it was a front-row seat to the greatest show on earth. He wasn't interested in the fundamentals of the companies or the gossip of the old men in the office. He was obsessed with the numbers themselves, with the way the prices moved. He began to notice patterns, rhythms, and behaviors in the price action. He saw that prices didn't move randomly. They moved in trends. A stock that was going up would show certain characteristic behaviors before it continued its rise, and a stock that was about to fall would do the same. He started keeping a little notebook, secretly jotting down his predictions based on the patterns he saw. He was testing his theories, developing his tape-reading skills. Soon, he had more confidence in his notebook than in the opinions of the senior brokers. One day, a colleague tells him about a sure-thing tip on Burlington stock. Livingston consults his notebook, and his own analysis tells him the stock is acting weak and is likely to go down. He decides to trust his own judgment. He walks into a nearby bucket shop, an establishment that was essentially a gambling den where you could bet on stock price movements without actually owning the stock. And he sells Burlington short. He was only 15 years old. The stock promptly dropped, and he made his first profit. This was the moment of discovery. He realized he had a unique talent for reading the tape, for discerning the market's intentions directly from the price action. He quit his job as a board boy and started frequenting the bucket shops full-time, armed with his notebook and his rapidly growing skills. He was so good, in fact, that he quickly earned the nickname the Boy Plunger for his willingness to take large positions. He was a prodigy, a natural at the game. This first chapter establishes the foundation of his entire career. A deep, intuitive understanding of price behavior and an unwavering belief in his own independent analysis over the opinions and tips of others. Modern takeaway. The world of the bucket shop may be gone, but its spirit is alive and well. A bucket shop was an operation that took the other side of its customers' bets, knowing that the vast majority of amateur speculators would lose. They profited from their clients' failure. One could argue that some modern unregulated crypto exchanges or contract for difference, CFD, brokers operate on a very similar model, providing immense leverage to inexperienced retail traders. Livermore's origin story is the tale of every successful technical trader. He didn't have fancy software or algorithms. He had a chalkboard, a notebook, and intense focus. This is the art of price action trading. Modern traders do the same thing, but instead of watching a board boy, they are watching candlestick charts, order flow data, and volume profiles on their computer screens. They are trying to do exactly what Livermore did, discern the market's future intentions by analyzing its present behavior. This chapter is a powerful lesson in the importance of screen time and focused observation. You don't learn to trade from a book or a YouTube video alone. You learn by watching the market, hour after hour, day after day, until its patterns become second nature. It also teaches the crucial lesson of thinking for yourself. The first trade Livermore made was by ignoring a hot tip and trusting his own work. That is a principle that separates the professional from the amateur, now as much as it did a century ago. Chapter 2. In this chapter, Livingston's success in the bucket shops becomes a problem. He is winning so consistently that he is no longer welcome. The bucket shop owners, who make money when their clients lose, see him as a threat to their business model. They start imposing special rules on him, like forcing him to put up a larger margin or refusing to take his trades on active, volatile stocks. Eventually, they simply ban him altogether. He has become too good at beating their game. This forces him to make a momentous decision. He must leave the small pond of the bucket shops and go to the ocean. He must go to New York and trade on the legitimate New York Stock Exchange. He arrives in the city with about $2,500, a significant sum for a young man in that era. He is supremely confident, believing that his tape reading skills, which were invincible in the bucket shops, will translate perfectly to the real market. He opens an account with a proper brokerage firm and starts to trade, but he immediately runs into a problem he had never faced before: slow execution. In the bucket shop, his bets were instantaneous. He saw his price on the ticker, and he could place his trade at that exact price. But on the real stock exchange, there was a delay. He would see his price, give his order to the broker, and by the time the order was executed on the trading floor, the price had often moved against him. This slight delay, this friction in the system, completely threw off his finely tuned tape-reading method, which was designed for a world of instant execution. He starts to lose money. He is still reading the tape correctly, but the mechanics of the real market are working against him. His confidence is shaken for the first time. The game in New York is different, faster, and more complex than the simple betting game he had mastered. He loses trade after trade, and his initial stake of $2,500 begins to dwindle. He is forced to confront the painful reality that what worked in one environment might not work in another, and that his education in the art of speculation was far from over. This chapter is about his humbling first encounter with complexities of the big league, a world where the speed and efficiency of your execution are just as important as the quality of your analysis. Modern takeaway. Livermore's rude awakening in New York is a timeless lesson in the importance of understanding market microstructure. The modern trader faces a similar, though technologically different, set of challenges. An amateur trader might develop a strategy that works well in a demo account or through backtesting. They feel confident and ready to trade real money. But when they go live, they are hit with the realities of slippage and spreads. Slippage is the difference between the price you expect to get and the price at which your trade is actually filled. In fast-moving markets like cryptocurrency, this can be a huge problem. You might see Bitcoin at $60,000 and hit buy, but by the time your order is processed, the price has jumped to $60,100. This is the modern equivalent of Livermore's execution delay. The bid-ask spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. For every trade you make, you are crossing the spread, which is an immediate small loss, a transaction cost. For a high-frequency trader or scalper, these small costs can be the difference between a winning and losing strategy. This chapter teaches us that a trading idea is not enough. You must also understand the mechanics of the market you are trading in. Are you trading a liquid stock like Apple, where spreads are tight and slippage is minimal? Or are you trading a new, illiquid altcoin, where a single large order can move the price dramatically and your execution can be terrible? Livermore's first failure in New York was a failure to adapt his strategy to the realities of a new trading environment. It's a mistake that traders still make every single day. Chapter 3. This chapter chronicles Livingston's first major wipeout. Still struggling with the slow execution of the New York brokerage houses, he continues to hemorrhage money. He is whipsawed by the market's short-term fluctuations, and his once unshakable confidence is completely gone. He goes from being the boy plunger to just another broke speculator. He loses his entire stake and is forced to borrow a few $100s from his broker just to get by. Humbled and defeated, he realizes he cannot win the game in New York. Not yet. He needs to go back to what he knows. He takes his small borrowed stake and goes on a tour of the bucket shops in other cities, like St. Louis, where his reputation isn't known. He has to use disguises and trade under assumed names because the Bucket Shop Syndicate has blacklisted him. He is essentially an outlaw, a card counterband from casinos. This period is crucial for his development. He is no longer the cocky kid who thought he had the game all figured out. He is now a desperate man, trading to survive. He meticulously rebuilds his stake, applying his tape-reading skills in the environment where they work best. He describes the intense mental focus required, the need to be patient and wait for the perfect, high-probability setup. He is not just gambling. He is a professional, applying his edge with discipline. After accumulating a few $1,000s, he decides he is ready for another attempt at New York. He returns with a new understanding. He knows he can't just apply his old methods blindly. He has to adapt. He realizes a profound truth. His big mistake was not just about slow execution. It was about over-trading and lacking patience. In his desperation to make money quickly, he was taking small, marginal trades instead of waiting for the big, clear moves. He tells the famous story of being in his broker's office, watching the market go up day after day. He feels the intense urge to trade, the itch to be in the game, but something holds him back. His tape reading tells him that while the market is strong, the line of least resistance is not yet clearly defined. He sits on his hands for days, watching other people make money, fighting the powerful emotions of impatience and FOMO. Finally, the market gives him the clear signal he has been waiting for. He takes a large position and catches the beginning of a major bull run. He has learned his first great lesson. There are times to trade, and there are times to sit on the sidelines. The money is not made by being in the market all the time, but by being in the market at the right time. Modern takeaway. Livermore's first blow-up is a rite of passage for almost every serious trader. It is the moment when the market's tuition bill comes due. The modern equivalent is a trader who, after some initial success on Robinhood, gets overconfident, starts trading with too much size or leverage, and blows up their account in a single bad trade on a volatile meme stock or a crypto future. The intense feeling of needing to be in the action is a powerful psychological force in today's markets. The 24/7 nature of crypto trading and the constant stream of chatter on Twitter and Reddit create a perpetual sense of urgency. It feels like if you're not trading, you are missing out. Livermore's lesson is a powerful antidote to this. He teaches us that patience is a form of action. Sometimes the most profitable trade is the one you don't take. A professional trader's job is not to trade every day. Their job is to wait patiently for a high probability opportunity. Their A+ setup and then act decisively. This is the difference between an amateur and a professional. The amateur wants to trade all the time. The professional wants to wait for the easy money. A modern trader can practice this by having a strict checklist for their trades. I will only trade when the stock is above its 50-day moving average, when volume is above average, and when the broader market is in an uptrend. This kind of filter forces patience and prevents overtrading. Livermore learned this lesson the hard way, by going broke. We can learn from his story. Chapter 4. Now back in New York with a fresh stake and a new sense of discipline, Livingston begins to mature as a speculator. He has moved beyond simply reading the tape for small, intraday moves. He is starting to think about the bigger picture, about catching the major swings that can last for weeks or months. This is where he learns one of his most famous and important lessons. The big money is not in the thinking, but in the sitting. He recounts a story where his analysis tells him that the market is in a powerful bull phase. He buys 10,000 shares of stock, and it quickly goes up, giving him a handsome paper profit. The old Livermore, the boy from the bucket shops, would have been tempted to snatch that quick profit and look for the next trade. This is a very common impulse for amateur traders. The fear of a winning trade turning into a loser makes them sell far too early. But the new, more mature Livingston fights this impulse. He has conviction in his analysis. He believes a major trend is still intact. So he does nothing. He sits tight. The stock continues to rise and his profits swell. He explains that it was never his brilliant ideas that made him the big money. It was his courage and discipline to hold on to his winning positions. He says, men who can both be right and sit tight are uncommon. This leads him to another critical insight, the danger of averaging down. He observes that many traders, when a stock goes against them, will buy more at a lower price. They tell themselves they are getting a better average price. Livermore sees this as a cardinal sin. If you bought a stock at $50 and it's now trading at $40, your initial analysis was wrong. Buying more at $40 is just throwing good money after bad. It is an act of hope, not of disciplined speculation. His rule is the opposite: never average down. Instead, he learns to average up or pyramid. If he buys a stock at $50 and it goes to $60, this confirms his analysis is correct. The market is validating his judgment. At this point, he might buy more, adding to a winning position. He is pressing his bets when he is right, not reinforcing his mistakes when he is wrong. This chapter marks a major evolution in his thinking. He is transforming from a scalper who takes small bites out of the market into a true swing trader who can capture the heart of a major trend. He is learning that the real skill is not just in being right, but in having conviction to stay right. Modern takeaway: the lesson of sitting tight is perhaps one of the most difficult for modern traders to learn. The constant stream of information and the ability to check your P&L every second on your phone creates an intense pressure to do something. When you're sitting on a big winning trade in a hot tech stock like Nvidia or cryptocurrency like Ethereum, the temptation to sell and lock in the profit is immense. Every small dip feels like the beginning of a major reversal. Livermore's wisdom teaches us to focus on the major trend. If the fundamental reason for your trade are still valid and the trend is still intact, your job is to have the discipline to do nothing. The concept of pyramiding is also a powerful professional technique. An amateur trader who gets a winning trade on Tesla might sell it for a quick 10% gain. A professional who believes Tesla is in a major uptrend might buy an initial position and then add to it as it breaks out to new highs, confirming their thesis. They are increasing their exposure as the trade works in their favor. This is how small wins are turned into massive, account-changing wins. Contrast this with the common behavior seen on platforms like Robinhood, where traders often fall in love with a stock and continue to buy the dip as it collapses. Think of the investors who kept averaging down on stocks like Peloton or Zoom after their pandemic bubbles burst. They were reinforcing failure, hoping the stock would return to its former glory. Livermore's rule is ruthless but effective. If a stock is not acting right, get out. Only add to positions that are working for you. This chapter contains a secret to outsized gains. Identify the trend, get in, and have the courage to sit tight. Chapter 5. In this chapter, Livingston describes one of his most spectacular successes and a profound lesson he learned from it. The year is 1906. The stock market has been in a massive bull run for years, and prices are at historic highs. Everyone is optimistic. But Livingston, studying the tape and the broader financial conditions, starts to feel uneasy. He sees signs of excess, of speculation getting out of hand. More importantly, he sees that credit is becoming tight. The call money rate, the interest rate brokers charge on margin loans, is starting to spike. This, he knows, is a major warning sign. When the fuel for speculation, easy money, starts to dry up, the fire is likely to go out. Based on his analysis, he concludes that the bull market is exhausted and a major correction is coming. He begins to sell stocks short, betting on a decline. At first, the market continues to creep up. He takes some small losses. His friends and fellow brokers think he is crazy. The market is strong. Why are you fighting it? They ask. But Livingston has conviction in his thesis. He is not just looking at the price. He is looking at the underlying conditions. Then comes the Great San Francisco earthquake of April 18, 1906. The city is devastated by the quake and the fires that follow. Livingston immediately understands the financial implications. The insurance companies will have to pay out massive claims, which will force them to sell their huge holdings of stocks and bonds to raise cash. This sudden, massive wave of selling will crash the market. His bearish thesis is now confirmed by a catastrophic event. He aggressively shorts the market, focusing on stocks like Union Pacific, a leading railroad company. The market begins to plummet, as he predicted. He amasses a huge short position. Then, something strange happens. The market has a sharp, violent rally. Livingston is sitting on a massive paper profit, and this rally is eating into it. The temptation to cover his shorts and take his money is immense, but he consults his principles. Is a fundamental condition, the need for the insurance companies to sell, still true? Yes. So he sits tight, the rally fizzles out, and the market resumes its plunge. He eventually covers his shorts near the bottom, walking away with a profit of $250,000, a colossal sum at the time. The lesson he learns is monumental. A man must trust his own judgment. He had the correct analysis, and he had the courage to act on it when everyone else was bullish. And crucially, he had the discipline to sit tight through a scary counter-trend rally because his underlying thesis was still intact. He had not just made a winning trade. He had proven to himself that he could stand alone against the crowd and be right. Modern takeaway. This story is the ultimate case study in macro trading and contrarian thinking. A modern-day Livermore might have looked at the housing market in 2006 to 2007. While everyone was euphoric, they might have studied the underlying conditions, the proliferation of subprime mortgages, the crazy valuations, and concluded that a crash was inevitable. They would have started shorting bank stocks or buying credit default swaps, just as Michael Burry and others depicted in The Big Short did. They would have had to endure months of the market moving against them, being told they were fools, before their thesis was spectacularly vindicated by the 2008 financial crisis. The story also contains a vital lesson about reacting to news. The San Francisco earthquake was a classic black swan event. Livingston didn't predict the earthquake, but he was prepared for a bearish scenario and was able to immediately understand the news' market impact and act on it decisively. A modern trader might do the same in response to a surprise interest rate hike from the Federal Reserve, an unexpected geopolitical event, or a major technological breakthrough. Finally, the lesson of sitting through a counter-trend rally is critical for anyone trading volatile assets like cryptocurrencies or high-growth tech stocks. In a major crypto bear market, there can be face-ripping rallies of 30 to 40% that convince everyone the bottom is in. A trader who is short must have a conviction to hold their position if their macro thesis hasn't changed. This chapter teaches us that the greatest trades often come from having a unique, well-researched viewpoint and the courage to stick with it, even when it's uncomfortable. Chapter 6. This chapter explores one of the most persistent and dangerous pitfalls for any trader: listening to tips. After his massive success shorting the market in 1906, Livingston is now a well-known and respected figure on Wall Street. He has made his first fortune. He is confident, and his judgment has been proven correct on a grand scale. And this is precisely when he becomes most vulnerable. He tells the story of a man he calls Mr. Partridge, an older, seemingly wise and experienced broker in his office. Mr. Partridge is a charismatic figure who is always willing to offer his opinion on the market. One day, he pulls Livingston aside and gives him a hot tip about a particular stock. He has it on good authority from insiders that the stock is about to make a huge move. The old Livingston, the boy from the bucket shops, would have ignored this. He would have consulted his own tape reading and made his own decision. But the new, successful Livingston is a bit more complacent. He respects Mr. Partridge. The tip sounds plausible. So, against his better judgment, he buys the stock. The stock does nothing. It stagnates, and then it starts to drift down. He is now holding a losing position in a stock he never would have bought based on his own analysis. He is angry at himself for breaking his own rules. He eventually sells the stock for a loss. The experience is a painful but invaluable reminder. He formulates a new rule for himself. The market is not a place of charity. No one is going to give you easy, winning tips out of the goodness of their heart. A true insider who knows a stock is going up will be quietly buying for themselves, not broadcasting it to the world. Most tips, he concludes, are either coming from people who don't know what they're talking about, or worse, from people who are trying to manipulate you. They might be trying to unload their own stock onto an unsuspecting public. He learns that relying on the judgment of others is a form of intellectual laziness. To be a successful speculator, you must do your own work and have the courage to trust your own conclusions. You must be responsible for your own ideas. If you are right, you get the credit. If you are wrong, you take the blame and learn the lesson. Outsourcing your decisions to someone else means you learn nothing. Modern takeaway. The world of Mr. Partridge has exploded into a global, multi-billion-dollar industry. Today, we call them finfluencers. They're on YouTube, TikTok, Twitter, and Instagram. They are charismatic figures who project an image of wealth and success, and they are constantly offering tips on the next hot meme stock, altcoin, or tech company. They build huge followings of people who are desperate for a shortcut to wealth. Livermore's warning has never been more relevant. A modern trader who buys a cryptocurrency because their favorite YouTuber is shilling it is making the exact same mistake Livingston did with Mr. Partridge. They are abandoning their own judgment in favor of someone else's. They often don't understand the asset they are buying, and they have no plan for when to sell. They are simply acting on faith. This is especially dangerous because many influencers have a hidden agenda. They may have been paid by the crypto project to promote it. They may be holding a large position themselves and are trying to create exit liquidity by convincing their followers to buy so they can sell at a higher price. This is the modern version of the manipulative insider that Livermore warned about. This chapter teaches us a lesson in radical self-reliance. You must treat every tip, every piece of analysis you see online with extreme skepticism. Use the ideas of others as a starting point for your own research, but never ever make a trade based solely on someone else's opinion. Your money is your responsibility, and so are your decisions. Chapter 7. This chapter continues the theme of Livermore's maturation as a speculator and focuses on a critical psychological error: impatience. After learning the hard lesson about tips, he becomes even more committed to his own analysis. He is now looking for his next big play. The year is now 1907. He is convinced that the conditions that led to the 1906 crash have not been resolved. Credit is still tight, and the market is on shaky ground. He believes that another, even bigger, crash is coming. He establishes a short position, but he does it too early. The market is in a period of choppy, sideways action. It doesn't crash, but it doesn't rally either. It just drifts. Livingston is sitting in his short position, day after day, and nothing is happening. His capital is tied up, and he is growing impatient. He starts to doubt his own thesis. Maybe he is wrong. Maybe the worst is over. He finally gives in to his impatience. He covers his short position for a small loss, freeing up his capital to look for other opportunities. He tells himself he can always re-enter the short position later if the market starts to show clear weakness. No sooner has he covered his position than the market begins to collapse. The Great Panic of 1907 begins. His analysis was 100% correct, but his timing was off, and his impatience cost him his position right before the move of a lifetime. He is now on the sidelines, watching the market plummet day after day. Just as he had predicted, he is kicking himself. But he doesn't panic. He knows he must get back in. He waits for a small rally, a temporary bounce in the crashing market, and then he reestablishes his short position with conviction, selling into the rally. He catches the rest of the move down, a spectacular crash that forces the closure of the New York Stock Exchange. He ends up making his first $1 million on this trade. While the outcome was a success, the lesson he learns is from his initial mistake. He was right about the market's direction, but he was shaken out of his position by impatience. He realizes that having the correct idea is only half the battle. You must also have the patience to wait for the idea to play out. He concludes that a speculator must have two kinds of courage: the courage to enter a trade based on a conviction, and the courage to sit still and do nothing until the time is right. Modern takeaway. Impatience is one of the biggest killers of trading accounts in the modern, high-speed market. We are all conditioned for instant gratification. We want results now. This is a terrible mindset for trading. A trader today might have a brilliant thesis. For example, that a particular biotech stock is overvalued and is likely to fall. They initiate a short position, but the stock just trades sideways for a month. The trader gets bored. They see other stocks moving and feel like their capital is dead money. They close their short position to chase a hot meme stock. And the very next week, the biotech company announces bad news, and the stock crashes 50%. Their thesis was right, but their impatience was fatal. This is a common experience in the cryptocurrency markets as well. A trader might identify a promising new project and buy its token. But the token price stagnates for months while other coins are having massive rallies. The trader sells out of boredom and then watches in agony as the token they just so goes on a 100x run. Livermore's story teaches us that conviction must be paired with patience. Once you have done your research and established a position based on a strong thesis, you must give the trade time to work. Don't be swayed by the market's short-term noise or your own desire for constant action. As Livermore learned, sometimes the most difficult part of trading is the waiting. Chapter 8. This chapter contains one of the most famous and instructive stories in the entire book. After his $1 million haul from shorting the 1907 crash, Livingston is now on top of the world. He is no longer just a successful trader. He is a Wall Street legend. And this is when he receives a personal request from the most powerful man in finance, J.P. Morgan. The panic of 1907 is so severe that it is threatening to bring down the entire American financial system. J.P. Morgan has assembled a consortium of bankers to try and restore confidence and stop the crash. They are pumping millions into the market to support prices. However, there's a problem. The great bear, Larry Livingston, is still aggressively shorting the market. His constant selling pressure is making it difficult for Morgan's group to stabilize things. An emissary is sent from Morgan to Livingston with a message. Mr. Morgan would like you to stop. It is a request, but it is a request from a man who could crush him. Livingston understands the gravity of the situation. He also feels a sense of patriotic duty. He is not trying to destroy the country. He is just a speculator playing the game. He agrees to not only stop selling, but to start buying. He changes his position from short to long, supporting the market alongside Morgan. The panic eventually subsides. But this is not the main lesson of the chapter. The main lesson comes from what happened before the crash. In the cotton market, Livingston had been trading cotton and had built up a massive long position. His analysis told him cotton was going higher. Then, a very wealthy and respected older trader, a man he admired, took him aside and advised him to sell. The older trader laid out a very compelling, logical, and bearish case for why cotton was about to fall. Livingston was shaken. This man was a giant of the cotton pits. How could he be wrong? Out of respect and a moment of self-doubt, Livingston sold his entire long position. He then watched in agony as cotton went on one of the biggest bull runs in history, a move that would have made him a massive fortune. He had made the same mistake he made with Mr. Partridge, but on a grander scale. He had allowed the opinion of a respected authority figure to overrule his own deep and thorough analysis. He vows, once and for all, that he will never again listen to anyone else's opinion when it comes to his own trades. He realizes that the wealthy old trader was not trying to trick him. He was just wrong. And even the most experienced experts can be wrong. The only judgment a speculator can ever truly trust is his own. Modern takeaway. The pressure to listen to authority figures is immense in today's financial world. We have a pantheon of modern-day J.P. Morgans, billionaire hedge fund managers, famous CEOs, and highly respected market analysts. When one of these figures speaks, the market listens. Think about the influence of a figure like Kathy would during the 2020 to 2021 bull market. She was seen as a visionary, and her ARK Invest funds were soaring. Many investors blindly bought the stocks she was buying, assuming she knew best. They were substituting her judgment for their own. When her funds crashed, these investors were left with huge losses and no conviction of their own to guide them. They had made the cotton market mistake. The same happens when a famous investor announces they are shorting a popular stock like Tesla. Many people will short the stock as well, simply because a guru did. They haven't done their own research. They don't understand the thesis. And when the stock rips higher, they are forced to cover in a panic. Livermore's painful experience is a powerful warning against this kind of hero worship. You must respect the opinions of smart people, but you must do your own work. Your P&L is a reflection of your decisions, not theirs. This chapter teaches us that true conviction cannot be borrowed. It must be earned through independent thought and analysis. Chapter 9. In this chapter, Livermore reflects on a key aspect of speculation that separates a professional from the amateur, understanding the nature of the game. He argues that the stock market is not a logical or mathematical puzzle to be solved. It is a game of human psychology. He says, the stock market is never obvious. It is designed to fool most of the people most of the time. He explains that the public is constantly looking for easy answers, for simple rules that will always work. They want to be told what to do. They buy a stock because it is going up, and they sell it because it is going down. They're always reacting to the immediate past. The professional speculator, on the other hand, is always thinking about the future. They are trying to anticipate, not react. He introduces a crucial concept, the line of least resistance. He believes that prices move in trends, and a trend will continue until a clear force emerges to stop it. The speculator's job is to identify the direction of the prevailing trend, the path of least resistance, and align themselves with it. This means buying in a bull market and selling in a bear market. It sounds simple, but it is psychologically very difficult. It is human nature to want to buy things when they are cheap and sell them when they are expensive. This instinct leads many traders to try and bottom fish in a bear market, buying as prices fall, or top tick in a bull market, selling as prices rise. This, Livermore says, is a losing game. It is like trying to swim against a powerful current. It is far easier and more profitable to swim with it. Chapter 11. In this chapter, Livermore reflects on the psychological evolution a speculator must go through to achieve long-term success. He has now made and lost several fortunes. He is no longer the boy plunger, relying on pure intuition, nor is he the overconfident young man who thought he knew everything. He is a seasoned professional who understands that the market is a relentless teacher, and its lessons are often brutal. He discusses the critical difference between a bull market and a bear market. He says that while it is tempting to think you can make money on both sides with equal ease, the reality is that the vast majority of people can only make money in a bull market. It is easy to be long and right when the entire market has a tailwind. The real test of a speculator is their ability to navigate a bear market, which requires a completely different mindset. In a bear market, the line of least resistance is down, and one must be willing to sell short or sit in cash. This leads to one of his most important philosophical insights. A speculator must not be an investor. The investor buys a company for the long haul, based on its fundamental value. The speculator is concerned only with the direction of the next major price move. An investor might see a 20% drop in their stock's price as a buying opportunity. A speculator, Livermore argues, must see it as a warning sign that their initial thesis was wrong and that they should be out of position. You cannot mix the two games. If you are a speculator, you cannot allow yourself to become an involuntary investor by holding on to a losing trade and hoping it will come back someday. He also talks about the importance of managing your personal life. After one of his big wins, he buys a yacht and lives a lavish lifestyle. He finds that this distracts him from the market. His mind is not sharp, and he starts making sloppy trades. He learns that to be at the top of his game, he needs to be completely focused. Speculation is a full-time job for the mind, and it does not allow for distractions or complacency. He concludes that a man must completely sell down to the sleeping point, meaning he must manage his positions and risk in such a way that he can go home at night and sleep soundly, without worry. If your position is keeping you up at night, it is too big. Modern takeaway. The distinction between speculating and investing is a crucial lesson for the modern participant in the FIRE movement. Many people start with a sound, long-term plan of investing in low-cost ETFs. But then they get tempted by the quick gains they see in cryptocurrencies or meme stocks. They start speculating with a small part of their portfolio. Often, the speculative portion grows and starts to dominate their thinking. They begin checking prices constantly and making emotional decisions. They have violated Livermore's rule. Don't mix the games. If you are a long-term investor, be an investor. If you're going to speculate, do it with a separate, small pool of capital and a completely different set of rules. The advice to sell down to the sleeping point is perhaps the most practical piece of risk management advice ever given. In the 24/7 crypto market, it is incredibly easy to become over-leveraged and obsessed. People stay up all night watching the charts, their health and personal relationships suffering. This is a clear sign that they have too much risk on the table. A modern trader must define their risk per trade, e.g., never losing more than 1% of their account on a single idea, and their total portfolio risk in a way that allows them to live a balanced life. If your Tesla stock position or your Bitcoin holdings are causing you constant anxiety, Livermore would say you have a size problem, not a market problem. Chapter 12. This chapter delves into one of the most difficult psychological challenges a trader faces: ego. Livermore has now reached a point where he is so successful and famous that his own actions can move the market. This creates a dangerous temptation to try and make the market do what he wants, rather than following what the market is telling him. He tells a cautionary tale about his trading in cotton. He had a strong bullish conviction based on his analysis of supply and demand. He built a massive long position. The market went up, but not as much as he expected. It was sluggish and weak. The tape was telling him that something was wrong, that the upward momentum was not there. But Livermore was a millionaire. He was the great Larry Livingston. He believed he was right, and he was determined to prove it. Instead of listening to the tape and selling his position, he decides to support the market. He starts buying even more cotton, trying to single-handedly push the price up. He is no longer speculating. He is trying to dictate terms to the market. This is an act of pure hubris. He becomes the entire market for cotton, but he cannot fight the underlying reality forever. Eventually, he is forced to confront the fact that his thesis was wrong. He has to liquidate his enormous position, causing the price to crash and resulting in a catastrophic loss of millions of dollars. He is wiped out once again. The lesson he learns is devastating, but essential. The market is always bigger than you are. No matter how smart you are, how rich you are, or how right you think you are, you cannot impose your will on the market. Your ego is your greatest enemy. The moment you stop listening to the market's message and start trying to tell it what to do is the moment you are doomed. He concludes that a speculator must fight the human desire to always be right. You must be able to admit you are wrong, quickly and unemotionally. A loss is not a reflection of your worth as a person. It is simply feedback from a market. The professional accepts this feedback and moves on. The amateur argues with the feedback, fights it, and ultimately gets destroyed by it. This is the difference between a long and successful career and a short, spectacular flameout. Modern takeaway: the danger of ego is magnified in the age of social media. Traders can now build huge followings on Twitter or YouTube. They become gurus, and their followers hang on their every word. This can create a powerful psychological trap. Once you have publicly declared that Bitcoin is going to $100,000, it becomes very difficult to change your mind, even if the price action is telling you the bull market is over. Your ego is now on the line. Admitting you are wrong means losing face in front of your entire audience. We saw this play out with many finfluencers during the 2022 crypto crash. Many of them kept telling their followers to buy the dip and HODL all the way down because their personal brand and ego were tied to the bullish narrative. They couldn't adapt to the changing reality of the market. Livermore's story is a stark warning to anyone who builds a public persona around their market calls. For the individual trader, the lesson is more personal. It's about detaching your self-esteem from your P&L. A modern trader can practice this through journaling. By objectively reviewing their losing trades, they can learn to see them not as personal failures, but as data. My entry was correct according to my system, but the trade failed. This is a normal outcome. This kind of objective self-talk helps to dismantle the ego's grip on your trading. As Livermore learned at great cost, the market is the ultimate humbler. It's better to embrace that humility willingly than to have it forced upon you. Chapter 13. After being humbled by his massive loss in the cotton market, Livermore is once again broke and in debt. This chapter is about his slow, methodical climb back to solvency. It is a powerful lesson in resilience and the psychology of starting over. He is now a middle-aged man, not a young prodigy. He has to go to his old brokers and ask them to stake him with a small trading account. This is a deeply humbling experience for a man who was once the king of Wall Street. He starts trading again, but with a completely new mindset. He is no longer the boy plunger taking huge, risky bets. He is a careful, patient, and methodical operator. He trades with very small size, feeling his way back into the market's rhythm. He is not trying to get rich quick. He is just trying to get back on his feet. He describes this period as one of intense focus and discipline. He knows that a single mistake could wipe him out for good. He waits patiently for his perfect setups. He follows his rules with an iron will. He takes small profits and cuts his losses instantly. Slowly, painstakingly, he builds a small stake into a larger one. He is proving to himself and to the world that his skills are still intact. The chapter's central theme is the idea that speculation is a business, not a gamble. It must be treated with the seriousness and professionalism of any other enterprise. When you are running a business, you don't make reckless bets. You manage your inventory, you control your costs, and you focus on consistent execution. Livermore is now running his trading as a business. His capital is his inventory, and his number one job is to protect it. He also reflects on the loneliness of the speculator. He notes that a successful trader must be a solitary thinker. You cannot be influenced by the hopes and fears of the crowd. You must do your own work, trust your own judgment, and be willing to stand alone. This period of rebuilding, when he had no one to rely on but himself, solidified this belief in him forever. It was his crucible, forging the final version of the master speculator. Modern takeaway. The story of Livermore's comeback is an inspiration for any trader who has ever blown up an account. It is a common experience, especially in the volatile world of crypto or options trading. The emotional aftermath of a big loss can be devastating. Many people quit the game forever. Livermore's story shows that it is possible to come back, but only with a radical shift in mindset. The key is to treat trading like a business. A modern trader can do this by creating a formal trading plan. This document would outline their strategy, their risk management rules, e.g. the 1% rule, their process for reviewing trades, and their goals. It turns trading from a haphazard emotional activity into a structured, professional operation. The idea of starting small after a big loss is also a critical piece of practical advice. If you blow up your account trying to trade leverage futures, the answer is not to fund a new account and do the same thing. The answer is to go back to a demo account or trade with micro size until you have proven that you can be consistently profitable on a small scale. You must earn the right to trade bigger. Livermore's journey from millionaire to debtor and back again is a powerful reminder that in the market, you are only as good as your last trade. Discipline, professionalism, and a relentless focus on capital preservation are the keys to longevity. Chapter 14. In this chapter, Livermore shifts from telling his personal story to offering more direct philosophical advice on the art of speculation. He discusses the crucial difference between stock gambling and intelligent speculation. A gambler, he says, is acting on blind hope. They are looking for a thrill, for easy money, without any real basis for their actions. An intelligent speculator, on the other hand, is acting on a well-reasoned forecast based on their deep analysis of market conditions. He emphasizes the importance of anticipating future probabilities. He says that the game of speculation is not about the present, but about the future. You are not paid for what everyone already knows. You are paid for correctly anticipating what is not yet obvious. This requires deep, independent thinking. You cannot make money by following the crowd, because by the time the crowd understands a move, it is already over. This leads him to a discussion of market timing. He is a firm believer that it is not enough to be right about a stock's direction. You must also be right about the timing. He explains that it is often wise to wait for the market to confirm your judgment before entering a trade. For example, if you believe a stock that is trading at $50 is going to go to $100, you don't necessarily need to buy it at $50. He often preferred to wait until the stock started to show strength, perhaps by breaking out to a new high at $60. Buying at $60, even though it's a higher price, might actually be safer because the market itself is now confirming the bullish trend. He calls this waiting for the psychological moment to act. He also introduces one of his most powerful concepts, studying human nature. He says that he has learned as much from studying his own mistakes and the mistakes of other traders as he has from studying the tape. The patterns of price movement are simply a reflection of the patterns of human emotion. Greed, fear, hope, and ignorance are the real forces that drive the market, and they have not changed in hundreds of years. The speculator who understands human nature has a tremendous edge because they can anticipate how the crowd is likely to react to certain news or price movements. Modern takeaway. The distinction between gambling and intelligent speculation is at the heart of the modern retail trading debate. A person who buys an out-of-the-money, weekly call option on test of the day before earnings, hoping for a massive payday, is a pure gambler. A person who analyzes the long-term trend of the electric vehicle market, waits for Tesla stock to pull back to a key technical support level, and then buys the stock with defined stop loss is an intelligent speculator. The difference is the process. Livermore's ideas on timing and confirmation are central to the field of technical analysis. The entire concept of a breakout strategy is based on philosophy. A modern trader will not just buy stock because it looks cheap. They will wait for the price to break above a key resistance level on high volume. This breakout is the market's confirmation that the buyers are now in control, and it is a psychological moment to enter the trade. This is a far more robust approach than simply trying to guess the exact bottom. Finally, the study of human nature is more relevant than ever in the age of social media-driven markets. A modern speculator can use tools like social media sentiment analysis to gauge the mood of the crowd. When they see a cryptocurrency like Dogecoin trending on Twitter and see signs of euphoric, irrational buying from the public, a Livermore-style speculator would see this not as a signal to buy, but as a signal that the move is likely exhausted and a reversal is coming. They are using their understanding of crowd psychology to position themselves against the emotional herd. Chapter 15. This chapter is a deep dive into the practical application of Livermore's trading philosophy. He lays out his system for managing a major campaign in a stock, which revolves around the concept of probing for the market's direction and then pyramiding his position. He explains that when he is considering a major trade, he does not just jump in with his full line of stock at once. This would be reckless. Instead, he starts by taking a small initial position, a probe. He is testing the waters. He might buy a small amount of stock he thinks is going up. He then waits and watches how the market reacts. If the stock immediately moves against him, it's a sign that his timing is wrong. He will sell the probe position for a small, quick loss and go back to waiting. No harm, no foul. However, if the stock moves in his favor, it is a green light. The market is confirming his judgment. This is when he begins to build his full position. He will add to his initial stake, buy more as the price rises. This is his famous pyramiding technique. He might buy his first lot at $50, his second at $52, his third at $55, and so on. He is only adding to a position that is already showing him a profit. His average price gets higher as he buys, but he is doing so with the market's momentum behind him. He is pressing his winners. He contrasts this with the amateur's approach. The amateur does the exact opposite. They put on their full position at once. If the stock goes down, they hold on and hope. Or worse, they buy more, averaging down, adding to a losing trade. Livermore's method ensures that he only takes a big position when the market has already proven him right. His initial probes are low-risk experiments. Only the successful experiments get more capital. He stresses that this method requires immense patience. You might make several small probes that result in small losses before you find a one that catches the beginning of a major move. The key is to keep the test losses small and to be ready to act decisively when a trade starts to work. It is a systematic, scientific approach to speculation designed to maximize the impact of being right and minimize the damage of being wrong. Modern takeaway. Livermore's probing and pyramiding strategy is a masterclass in risk management and position sizing. It is a technique used by many of the world's top trend-following funds and professional traders today. A modern trader can apply this to any market. Let's say a trader has a bullish thesis on Bitcoin. Instead of buying their full intended amount at $60,000, they might buy a 25% probe position. If Bitcoin immediately drops to $58,000, they might sell for a small control loss. If, however, Bitcoin rallies to $65,000, this confirms their thesis. They might then add another 25% of their position. If it continues to a new high of $70,000, they might add the rest. They have built their full position with the wind at their back, and their average cost is comfortably below the current market price. This is a far superior method to the common, all-in approach seen on platforms like Robinhood, where a trader will bet their entire account on a single idea at a single price. Livermore's method is about survival and longevity. It ensures that no single trade can knock you out of the game. It is a disciplined, professional way to engage with the market's uncertainty, and it is a powerful technique for turning a good idea into a great win. Chapter 16. In this chapter, Livermore reflects on the internal, psychological aspect of the game, particularly the concept of having an inside man in your own head. He argues that a speculator has to fight against two dangerous and deeply ingrained human emotions, hope and fear. He famously states that the market is driven by these two forces. Fear causes people to sell too early in a bull market, snatching a small profit because they are afraid of it turning into a loss. And fear causes them to panic and sell at the bottom of a bear market when the news is at its worst. Hope is even more dangerous. Hope is what keeps a trader clinging to a losing position. The stock is going down, the tape is screaming sell, but the trader hopes it will turn around. They hope they will get back to even. Hope in the stock market is the enemy of reality. Livermore says that the speculator must train himself to do the opposite of what hope and fear tell him to do. He must be fearful when others are greedy, and greedy when others are fearful. This means having the courage to sell stock that is going down, even if you hope it will recover, and having the courage to hold a stock that is going up, even if you are fearful of giving back profits. This is where the idea of the inside man comes in. He says that a speculator must fight the foolish opinions that come from his own emotional side. You have your rational, analytical side that has a well-thought-out plan. And then you have your emotional side that is whispering things based on hope and fear. The successful speculator is the one who can silence the emotional voice and listen only to the rational one. He concludes that the game is not just about reading the tape. It is about reading yourself. You must know your own psychological weaknesses and build rules and systems to protect yourself from them. A speculator's success is directly proportional to their level of self-mastery. Modern takeaway. The battle between hope and fear is the central drama of modern retail trading. Hope is the emotion that fuels the bag holder phenomenon in crypto and meme stocks. A person buys a stock at the peak of the hype. The stock then crashes 80%. Their rational analysis should tell them to sell and preserve their remaining capital. But hope kicks in. They hope for a return to the all-time high. They join online communities of other bag holders who reinforce this hope. They cling to position for years, their capital slowly bleeding away. This is hope as a destructive force. Fear is what causes a panic selling during a market crash. In March 2020, at the start of the COVID pandemic, the market was in a free fall. The news was terrifying. Fear was rampant. Many long-term investors, even those in the FIRE movement with sound plans, panicked and sold their ETFs at the absolute bottom, locking in massive losses. They let their fear overrule their rational, long-term plan. They then missed the spectacular recovery that followed. Livermore's advice is to create a trading plan that is so objective and rules-based that it leaves no room for hope and fear to operate. Your rules should tell you exactly when to get in and, more importantly, exactly when to get out. A stop-loss order is the ultimate tool for killing destructive hope. It is a pre-made decision to exit a losing trade at a specific price, executed automatically, without any emotional interference. By building this kind of objective system, the modern trader can protect themselves from the two powerful emotions that have been destroying speculators for centuries. Chapter 17. This chapter is a fascinating look at the power of market psychology and the danger of trying to force a trade when the timing is not right. Livermore is trading in the wheat market, and based on his analysis, he is extremely bullish. He believes the price of wheat is going much higher. He starts to accumulate a large long position. However, the market is not responding. The price is sluggish and refuses to go up. The tape is telling him there is a large, unseen seller who is meeting all the buy orders and keeping a lid on the price. The line of least resistance is not yet up. The old, egotistical Livermore might have tried to fight this, to buy even more and force the price higher. But the mature Livermore has learned his lesson. He recognizes that even if his long-term bullish thesis is correct, the immediate timing is wrong. There is a powerful force working against him. So, He does something brilliant. He decides to switch sides. He sells his entire long position and goes short, aligning himself with a powerful seller. The price immediately starts to drop, and he makes a quick and easy profit on the short side. He explains that his loyalty is not to the bull side or the bear side. His loyalty is to the side that is winning. He then waits. He knows the big seller will eventually run out of wheat to sell. He watches the tape like a hawk, looking for a change in character. He sees the selling pressure start to dry up. He sees the price start to firm up. He covers his short position and then reestablishes his original, massive long position. This time, the big seller is gone and the path is clear. The price of wheat explodes upward and he makes an absolute fortune. The lesson is multifaceted. First, don't argue with the tape. If the price action is not confirming your thesis, respect it. The market is telling you something is wrong. Second, be mentally flexible. Don't be so married to your opinion that you can't switch sides if the evidence changes. Third, and most importantly, understand that timing is everything. He was right about the ultimate direction of wheat, but he would have been financially and emotionally drained if he had tried to sit through the period of heavy selling. By getting out, getting on the right side for the short-term move, and then getting back in when the time was right, he maximized his profit and minimized his psychological pain. Modern takeaway. This story is a masterclass in tactical trading. A modern trader might have a strong bullish thesis on a tech stock like Apple, but they might notice on their level 2 screen that there is a huge sell wall, a massive block of sell orders at a certain price. This is the modern equivalent of Livermore's unseen seller. Instead of trying to punch through that wall, the trader might wait. They might even take a short-term scalp on the short side, betting the wall will hold. Then they will wait for the sell wall to be absorbed by the buyers. Once it is gone, they know the line of least resistance is now up, and they can enter their main long position with much higher confidence. This kind of flexibility is crucial in the volatile crypto markets. You might be a long-term Bitcoin bull, but if the short-term price action is clearly bearish, a tactical trader might hedge their position or even take a short trade to profit from the downdraft. They are not abandoning their long-term belief. They are simply respecting the reality of the now moment, just as Livermore did. This chapter teaches us that successful speculation is not a rigid, dogmatic exercise. It is a fluid dance with the market, requiring adaptability, patience, and humility to admit when the timing is not right. Chapter 18. In this chapter, Livermore offers a powerful piece of advice that seems counterintuitive but is essential for long-term success. Don't be in a hurry to get rich. He reflects on his own career and the careers of many other traders he has known. He notes that the traders who are the most desperate to make a lot of money quickly are almost always the ones who fail. He explains that this desperation leads to two fatal errors: overtrading and taking on too much risk. The trader who is in a hurry feels like they need to be in the market all the time, chasing every small wiggle. They cannot bear to be on the sidelines because they might miss an opportunity. This leads them to take low-probability trades and get chopped up by the market's noise. They also tend to bet too big on each trade, hoping for that one home run that will change their life. This means that a short string of normal, expected losses can wipe out their entire account. Livermore argues that the professional speculator must cultivate the opposite mindset. They must be infinitely patient. They must understand that the market does not offer life-changing opportunities every day or even every month. The truly great, high-probability setups are rare. The speculator's job is to preserve their capital and their mental energy so that they are ready to act decisively when one of these rare opportunities presents itself. He says that the market is like a long train journey. There will be many stations along the way. You don't have to get on the first train that comes along. You can afford to wait for the express train. He concludes that the desire to get rich quick is the single greatest enemy of the speculator. It clouds your judgment, destroys your discipline, and forces you to play a losing game. The path to wealth in the markets is a marathon, not a sprint. Modern takeaway. This lesson is perhaps the most important one for the modern generation of traders who have been brought up in the culture of instant gratification. The stories of people becoming millionaires overnight on Dogecoin or GameStop have created a completely unrealistic expectation of what is possible in the markets. This has fueled a massive wave of gambling, with people taking on huge risks they don't understand, hoping to hit the jackpot. Livermore's advice is a perfect antidote to the get-rich-quick culture promoted by so many finfluencers. A modern trader who internalizes this lesson will have a completely different approach. They will not feel the need to trade every day. They might spend most of their time researching and waiting, only acting when their strict criteria are met. They will use proper position sizing, risking only a small fraction of their account on any single trade, because they know that their success will be determined by their consistency over hundreds of trades, not by the outcome of one. This philosophy is also highly relevant to long-term investors in the FIRE movement. The temptation to speed up the journey to financial independence by taking on more risk in speculative assets can be immense. Livermore's wisdom reminds them that the surest path to wealth is often the slowest and most boring one. By focusing on a high savings rate and consistent, patient investing in ETFs, they are playing a winning game. By chasing speculative fads, they are risking the very foundation of their financial future. This chapter teaches us in the market, as in life, patience is a superpower. Chapter 19. This chapter is a fascinating discussion on the art of market manipulation. Livermore, having engaged in it himself, provides an insider's view on how it works and, more importantly, what its limitations are. He makes a crucial point that is often misunderstood. You cannot manipulate a stock down, and you cannot manipulate a stock up unless the underlying conditions are right. He explains that a manipulator cannot take a fundamentally strong stock in a bull market and force its price down for very long. Any artificial selling pressure they create will be quickly met by real buying from investors who recognize the stock's value. The manipulator will simply be handing over their shares to strong hands at a cheap price. Conversely, and more importantly, a manipulator cannot take a fundamentally weak stock in a bear market and artificially pump its price up indefinitely. This is a classic pump and dump scheme. The manipulator can create a flurry of buying and excitement, which might attract a greedy and ignorant public. But if the stock has no real value, the artificial bull run cannot be sustained. As soon as a manipulator stops buying, the price will collapse under its own weight. The public who bought at the top will be left holding the bag. Livermore's key insight is that a successful manipulation does not go against the trend. It goes with the trend, but it accelerates it. A smart operator who wants to push a stock higher will wait for a bull market and choose a stock that already has positive momentum. Their manipulative buying then acts as a catalyst, attracting the public and creating a feeding frenzy that might have happened anyway, but on a faster timescale. He concludes that the best defense against being a victim of manipulation is to do your own homework. You must understand the fundamental value of the stock you are buying. If you buy a sound company at a reasonable price, you don't need to worry about the short-term wiggles caused by manipulators. But if you buy a worthless stock at a high price simply because it is going up, you are making yourself a willing victim for the operators to fleece. Modern takeaway. This chapter is essential reading for anyone involved in the modern cryptocurrency and meme stock markets, which are rife with manipulation. The classic pump and dump is a daily occurrence in a world of altcoins. A group will hype a worthless coin on Telegram or Twitter. The price will spike as retail traders FOMO in, and then the original insiders will dump their holdings, crashing the price. Livermore's lesson is clear. If you are buying a coin that has no underlying utility, no real development, and no value other than its price, you are playing a manipulated game, and you are likely to be the victim. The GameStop saga can also be viewed through this lens. The initial short squeeze was a brilliant, organic move by a large group of retail traders. But as the price reached absurd levels, the dynamic shifted. It became a game of psychology, with both sides trying to manipulate the narrative and the price. A trader who understood Livermore's principles would have recognized that the price of GME was completely detached from its fundamental reality and that the bull run was unsustainable. They would have sold into euphoric buying rather than becoming a bag holder. This chapter empowers the individual investor. It tells you that you don't have to be afraid of the whales and the manipulators if you stick to your principles. If you focus on quality, demand a margin of safety, and align yourself with the major trend, you can navigate these treacherous waters safely. But if you chase hype and ignore fundamentals, You are setting yourself up to be someone else's exit liquidity. Chapter 20. In this chapter, Livermore introduces another one of his key trading principles, the importance of focusing on pivotal points. He explains that in his early days, he was just a tape reader, looking for small, immediate moves. But as he matured, he learned that the real money was in identifying and acting on the major turning points in a stock's trend. A pivotal point, as Livermore describes it, is a price level that, if crossed, is likely to signal the beginning of a major new move. It is a point where the balance of power between buyers and sellers is shifting decisively. This could be the breakout to a new all-time high after a long period of consolidation, or the breakdown below a critical support level after a long uptrend. He argues that a speculator should not be constantly nibbling at the market. They should wait patiently for a stock to reach one of these pivotal points. Trading at a pivotal point offers the best combination of high probability and a clear risk-reward profile. If you buy a stock as it breaks out through a pivotal point, you can place your stop loss just below that point. If the breakout is genuine, the stock should not return to that level. If it does, your thesis is wrong, and you can get out with a small, control loss. But if the breakout is real, it can be the start of a massive trend that can last for months. He stresses that identifying these points requires a deep study of price behavior. It's not just about a single price, but about the action of the stock as it approaches and interacts with that price. Is the volume increasing on the breakout? Is the stock showing strength and resilience? The pivotal point is a moment of truth, and the professional speculator lives for these moments. They are the points of minimum risk and maximum potential. Modern takeaway. The concept of pivotal points is the foundation of modern technical analysis and chart patterns. What Livermore called a pivotal point, a modern trader would call a key level of support or resistance. A breakout above a long-term resistance level is a classic bullish pivotal point. Think of a stock that has been stuck below $100 for a year. The day it closes above $100 on high volume, that is a pivotal point, and a breakdown below a key support level is a bearish pivotal point. Chart patterns like head and shoulders, cup and handle, and triangles are all just visual representations of a stock building up to a pivotal point. A modern trader uses these concepts every day. They will not just randomly buy a stock like Amazon. They will wait for it to form a clear consolidation pattern, and then buy it as it breaks out of that pattern, placing their stop loss just below the breakout level. This is a direct application of Livermore's pivotal point strategy. This approach provides a clear, objective framework for trading, which helps to remove emotion. You are no longer buying based on a feeling. You are waiting for the market to signal its intention at a key, predefined level. This discipline is essential for anyone trading in the volatile crypto or tech stock markets. By focusing your attention only on these high-probability pivotal points, you can filter out the market's random noise and significantly improve your odds of success. Chapter 21. In this chapter, Livermore offers a piece of cautionary advice that is born from his own painful experience. The danger of taking a flyer on a tip from a powerful insider. He tells the story of a man he calls Thomas F. Woodlock, a highly respected and extremely well-connected railroad magnate. This man is a true corporate insider, the kind of person who really does know what is going on inside his company. Woodlock takes a liking to Livermore and, as a friendly gesture, gives him a tip. He tells him that his railroad company is about to be acquired at a very favorable price. The deal is all but done. It is the ultimate insider tip. Livermore, who has previously sworn off tips, makes an exception. This is not some random broker like Mr. Partridge. This is the man himself. He buys a huge block of the stock, expecting a quick and massive profit when the deal is announced. But the deal is never announced. Some last-minute complication arises, and the acquisition falls through. The stock, which had run up in anticipation of the news, collapses. Livermore is forced to sell his entire position for a huge loss. The lesson he learns is profound. Even a well-intentioned tip from the most reliable insider in the world is not a guarantee. There are 1,000 slips between the cup and the lip. The business world is complex and unpredictable. A deal that seems certain can fall apart for any number of reasons. He concludes that there is no such thing as easy money in the stock market. Every trade is a risk, no matter where the information comes from. He realizes that by acting on the tip, he had once again become intellectually lazy. He had abandoned his own tape reading skills, which were telling him the stock was not acting right, in favor of a sure thing. He vows, for the final time, that he will only ever trade based on his own analysis of the price action. The tape, he says, tells you everything you need to know, and unlike an insider, the tape never lies. Modern takeaway. The temptation to act on supposed insider information is still a powerful lure. In the modern world, this often takes the form of rumors spread on internet forums or social media. A person might see a post on Reddit claiming to have an inside source that Apple is about to announce a revolutionary new product. They might then bet their life savings on Apple call options, expecting a huge payoff. This is the modern version of Livermore's mistake. The cryptocurrency world is particularly notorious for this. Rumors of a coin being listed on a major exchange like Coinbase or a new partnership with a big company can cause massive price spikes. Many traders try to front-run this news based on rumors. But just like Livermore's railroad deal, these things can fall through. The rumored listing might not happen. The partnership might be a dud. And the traders who bet the farm on the rumor are left with catastrophic losses. Livermore's story is a powerful argument for the principles of technical analysis over news-based trading. The technical trader believes that all the rumors, news, and insider knowledge are ultimately reflected in the price action. If a stock is truly going to be acquired, the smart money will be quietly accumulating it, and this will show up on the chart as increased volume and rising prices. The trader doesn't need to know the reason why it's going up. They only need to see that it's going up. By trusting the tape over the story, you can avoid being burned by the sure things that turn out to be anything but. Chapter 22. In this chapter, Livermore tackles the psychology of the public and the crucial role that patience plays in speculation. He has now reached the pinnacle of his profession and reflects on the common mistakes he sees amateurs make over and over again. He observes that the average person comes to the market looking for constant action and quick profits. They are not content to make money slowly. They want to get rich now. This chronic impatience, he argues, is the speculator's worst enemy. It leads them to overtrade, to take on too much risk, and to jump in and out of positions based on emotion rather than sound judgment. He then tells a story to illustrate his point. He is in his broker's office, and an ordinary man comes in, a member of the public. The man asks for a tip. Livermore's friend, the broker, tells him to buy a certain stock. The man buys it, and it immediately goes up a few points. The man is thrilled and sells it for a quick, small profit. He comes back the next day, asking for another tip. The cycle repeats. The man is making small, consistent profits and thinks he is a genius. Livermore watches this with a sense of pity. He knows that this man is playing a losing game. He is training himself to be happy with small gains. But the market is not a place where you can make a living by scalping small profits. The big money, Livermore repeats, is made by catching the big moves. And to catch a big move, you must have the patience to hold on to a winning position for weeks or even months. The man who is always snatching small profits will never be in a position to catch a major trend. He will sell his stock after a 5-point gain and then watch in agony as it goes up another 50 points without him. Livermore concludes that the public is always looking for the easy way, the shortcut. They don't want to do the hard work of analysis, and they don't have the patience to see a trade through. The professional speculator, on the other hand, understands that speculation is hard work. It requires deep study, immense patience, and emotional fortitude to go against your own instincts. Modern takeaway. The behavior of the man in the broker's office is a perfect description of the modern-day trading culture, especially as it exists on platforms like Robinhood. Many new traders are obsessed with making a small profit every single day. They are scalpers, try to catch tiny price movements. This is an incredibly difficult game to win, as you are constantly fighting against transaction costs, spreads, and the market's random noise. More importantly, as Livermore points out, it completely prevents you from capturing the big, life-changing trends. Consider the bull market in tech stocks after the COVID crash. A stock like Nvidia went on a multi-100% run over the next few years. The trader who was scalping for small daily gains would have been in and out of the stock dozens of times, making a small amount of money but missing the vast majority of the move. The trader who had the patience to buy the stock and sit tight, as Livermore advised, would have made a fortune. This chapter is a powerful argument against the mindset of high-frequency, low-profit trading for the individual. It is also a critique of the FIRE movement's potential dark side. While the movement is built on patience, the desire to reach financial independence faster can lead people to abandon their patient ETF strategy in favor of more active, speculative trading, where they often fall into the trap of taking small profits and missing the big picture. Livermore's lesson is clear. Patience is not just a virtue in the market. It is a prerequisite for a big success. Chapter 23. This chapter is a philosophical reflection on the nature of the game and the unique mindset required to succeed. Livermore argues that speculation is an art, not a science. There are no fixed rules or mathematical formulas that can guarantee success. Every market is different, and every situation is unique. The successful speculator is not a rigid technician, but a flexible artist who has a deep, intuitive feel for the market's rhythm and mood. He emphasizes that a speculator must be a student of not just the market, but also of history, economics, and human psychology. He says that all the major market movements are driven by underlying economic conditions. A speculator must understand the fundamentals of supply and demand, the role of credit, and the broader business cycle. He who knows only the chart knows nothing. This leads him to a powerful conclusion about the source of his own success. He says that his greatest insights did not come from a flash of brilliance, but from a deep and thorough study of the facts, combined with his long experience. He was not a gambler guessing at the market's direction. He was a detective, piecing together clues from the tape, from the news, and from his understanding of economic principles to form a logical forecast. He also stresses the importance of solitude. He repeats that a speculator must think for himself. He often went away on fishing trips or secluded himself in a private office where no one could bother him. He needed the quiet and the isolation to do his deep thinking, away from the noise and the emotional contagion of the crowd. He knew that the market's greatest secrets are not revealed in the midst of chaos, but in moments of quiet contemplation. This chapter elevates the act of speculation from a mere game of numbers to a high intellectual and artistic pursuit. It requires the analytical rigor of a scientist, the historical perspective of a scholar, and the intuitive feel of an artist. It is a lifelong game of learning and adaptation, and only those who are truly dedicated to mastering all its facets can hope to win. Modern takeaway. Livermore's view of speculation as an art form is a powerful counter-narrative to the modern, quantitative view of the market. Today, many believe that the markets can be solved with enough data and computing power. AI-driven trading models and high-frequency trading firms operate on the principle that the market is a mathematical system. Livermore would argue that this is a dangerously incomplete view. He would say that the quants can model the past, but they cannot model the future, because the future is shaped by human emotions and unforeseen events that are not in their data sets. His emphasis on a multidisciplinary approach is also a crucial lesson. A modern trader who only knows how to read a candlestick chart is at a disadvantage. A trader who also understands the macroeconomic environment, who understands how the Federal Reserve's interest rate policy is likely to affect the stock market or how a geopolitical conflict might impact the price of oil, has a much richer and more robust framework for making decisions. The need for solitude and independent thought is more critical and more difficult than ever. We are living in an age of constant connectivity and information overload. Our phones are always buzzing. Twitter, Reddit, and financial news channels are a constant stream of other people's opinions. It is incredibly hard to find the quiet space to do your own thinking. Livermore's practice of seeking solitude is a powerful piece of advice for the modern trader. You must carve out time to disconnect from the noise, review your own trades, study the charts without bias, and form your own independent conclusions. This is where your true edge will be found. Chapter 24. In the final chapter of the book, Livermore offers his concluding philosophical reflections on his life as a speculator. It is a somber and profound meditation on the nature of the game and the toll it takes on a man. He reiterates his core principles: which have been forged in the crucible of his immense wins and devastating losses. He repeats his most famous maxims. The game itself teaches you the game. You learn by doing and by losing. The stock market is a study of human nature. The patterns repeat because human emotions are constant. You must be right and sit tight to make the big money. You must control your emotions, especially hope and fear. The tape is the ultimate truth. Don't argue with it. He then tells one final story about a time he was on vacation in Palm Beach. He had no interest in the market and was just trying to relax. But the brokerage office in his hotel was always buzzing with a crowd of amateur speculators. He saw them making the same classic mistakes over and over again, buying at the top, listening to tips, and refusing to take a loss. He realized that the public never changes. They are a constant source of fuel for the market's moves, and they are almost always on the wrong side at the major turning points. He ends a book with a powerful and somewhat melancholy statement. He says that the game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. He has spent his entire life mastering this incredibly difficult art form. He has won fortunes beyond most people's wildest dreams. But the reader is left with a sense of the immense personal cost of this success, the loneliness, the stress, and the constant mental battle. The book does not have a happy, fairy tale ending. It is a realistic and unvarnished look at the life of a professional speculator. It is a story of incredible intellectual and psychological struggle, a story of a man who mastered the market but was never able to fully master himself. It is, in the end, a cautionary tale as much as it is an inspirational one. Modern takeaway. This final chapter serves as a powerful summary and a sober warning. The image of the amateur speculators in the Palm Beach brokerage office is a perfect metaphor for the modern retail trading environment. The Robinhood app, the Wall Street Bets forum, the crypto Twitter community. These are the modern-day Palm Beach offices, filled with people making the same timeless mistakes that Livermore observed a century ago. They are driven by hype, FOMO, and the desire for easy money. Livermore's final words are a challenge to anyone who wants to take the market seriously. Are you willing to do the hard work? Are you willing to study, to be patient, to control your emotions, and to take 100% responsibility for your own results? If not, he warns you will die poor. This is not necessarily a literal prediction, but a statement about the outcome of playing a professional's game with an amateur's mindset. The tragic end of the real Jesse Livermore's life. He died by suicide, having lost his final fortune, adds a layer of profound poignancy to this book. It is the ultimate proof of his own teachings. He was a genius at reading the market, but in the end, he could not conquer the demons of his own human nature. This makes the book's lessons even more powerful. It is not just about making money. It is about the pursuit of self-mastery, a battle that is fought not on the ticker tape, but in the quiet spaces of the human soul. This is the final, timeless lesson of the stock operator. Modern context expansion. What would Livermore say today? Let's engage in a thought experiment. If we could resurrect the ghost of Jesse Livermore and sit him in front of a modern trading station with its multiple monitors, flashing charts, and real-time news feeds, what would he think? He would be a kid in the world's most magnificent candy store, and he would also be the wisest, most cynical man in the room. Technology, a double-edged sword. Livermore, the master tape reader, would be absolutely mesmerized by modern technology. The ability to see every tick of every stock, every order in the crypto books, and every piece of global news, all in an instant, would seem like a superpower. He spent his life trying to get faster, more accurate information, and we have it all at our fingertips. Algorithmic and high-frequency trading. HFD, he would not see these as enemies. He would see them as the ultimate expression of the tape. He would view HFD algorithms as millions of tiny, lightning-fast tape readers, all reacting to the same price action. He would dedicate himself to understanding their behavior, looking for patterns in how they operate, and finding ways to exploit their machine-like tendencies. He would see them as just another, more powerful player in the game. Charting software, the ability to instantly pull up a chart of any asset, with any indicator over any time frame, would be a revelation. He, who had to keep meticulous handwritten ledgers, would be able to test his theories about pivotal points and trends with a few clicks. He would become a master chartist, but he would still insist that the patterns on the chart are only valuable because they are a picture of human psychology, cryptocurrency. Livermore would have been magnetically drawn to the crypto markets, their extreme volatility, their 24/7 nature, and the raw, untamed speculation would have been his ideal playground. He would have loved the challenge of trading an asset class with no fundamental anchor, a market driven purely by hope, fear, and narrative. He would have been a master at trading the booms and shorting the busts, and he almost certainly would have made and lost several fortunes in Bitcoin alone. Strategies, the timeless versus. The trivial how would Livermore view the dominant strategies of our time? Passive investing, ETFs, fire movement. He would be utterly dismissive, if not contemptuous, of this approach. He would see buying an index fund as an abdication of thought, a know-nothing strategy for people who lack the courage to have an opinion. He believed the market was a game to be played and won, not passively participated in. He would likely call it diversification and argue that you are guaranteed mediocre results by buying both the winners and the losers. He would not understand the mindset of someone who is content to simply match the market average, day trading and swing trading. He would see modern-day traders and swing traders as his direct descendants. He would recognize their chart patterns, their focus on momentum, and their attempts to capture short to medium-term trends. However, he would be critical of the hyper-short-term scalping that is so common. He would reiterate his belief that the real money is in the big swings, and he would urge traders to lift their gaze from the 1-minute chart and focus on the daily and weekly trends. Social media and finfluencers. Livermore would view platforms like Reddit's Wall Street Bets and Twitter as the most powerful fire hose of market sentiment ever created. He would be an avid but silent observer. He would use these platforms to gauge the psychology of the amateur public, to see where the sucker money was flowing. He would see the euphoric posts at the top of a bubble and the despairing posts at the bottom as the ultimate confirmation signals for his contrarian trades. He would view the influencers giving out tips as modern-day Mr. Partridges, and he would thank them for so clearly marking the trail of the uninformed money that he sought to trade against. Timeless principles as a shield in our complex, algorithm-driven world. Livermore's core principles would be his anchor. The tape is truth. In a world of fake news, competing narratives, and deepfake videos, he would argue that the price action is the only thing a speculator can truly trust. It is a final arbiter of all opinions. Follow the path of least resistance. This simple idea is a powerful filter for the noise. It would keep him out of crashing story stocks and align with the major secular trends, whether in AI, renewable energy, or any other sector. Control the inner fool. He knew the greatest danger was himself. In a world with one-click trading and instant access to leverage, he would argue that this internal discipline is 1,000 times more important than it was in his day. The tools for self-destruction are now more powerful than ever. Livermore would conclude that nothing has really changed. The technology is new, the names of the stocks are different, but the game is the same. It is a timeless battle of wits, courage, and discipline, played out on the grand stage of human emotion, and he would love every minute of it. Closing reflection. 10 timeless lessons from a stock operator. As we close the final pages of this incredible story, we are left with a collection of raw, powerful, and timeless truths about the market. Reminiscences of a Stock Operator is not just a biography. It is a foundational text on the art of speculation. If we were to distill Jesse Livermore's hard-won wisdom into its most essential lessons, they would be these 10 commandments of the game. The game teaches the game. You cannot learn to speculate from a book alone. Real knowledge is paid for with real money and real pain. Your losses are your tuition. Study them, learn from them, and never pay for the same lesson twice. The tape is the ultimate truth. The price action tells you everything you need to know. News, rumors, fundamentals, and opinions are all secondary. Learn to read the tape, and you will learn to read the market's mind. Don't argue with it. The big money is in the big swing. Don't be satisfied with small, quick profits. The greatest rewards come from correctly identifying a major trend and having the patience and courage to ride it. It was never the thinking that made the money. It was the sitting. Follow the path of least resistance. Don't try to be a hero by calling tops and bottoms. Determine the direction of the major trend and swim with the current, not against it. Buy in a bull market and sell in a bear market. Master yourself, master the market. The greatest battle is not with the market, but with your own human nature. You must conquer the twin demons of hope and fear. Hope is for losers, and fear will prevent you from winning. A speculator is not an investor. The two games have different rules. Never allow a speculation turn into a long-term investment by refusing to take a loss. Adding to a losing position. Get out is the speculator's cardinal sin, and wait for the next reinforcing failure. Add to your winners, not your losers. Press your bets only when the market has already proven you right. Sell down to the sleeping point. Your risk management should allow you to be at peace. If your position is causing you anxiety and keeping you up at night, your position is too big. No trade is worth your health or peace of mind. The market is designed to fool most people. The obvious move is almost always the wrong move. You must learn to think like a contrarian, to stand apart from the crowd, and to trust your own independent judgment. Patience, patience, patience. The market does not offer great opportunities every day. A professional speculator spends most of their time waiting, researching, and preserving their capital. So they are ready to act with decisive force when a rare, high-probability opportunity presents itself. How can a modern trader apply these lessons right now? Start by developing a deep respect for the game. Understand that this is not easy, and you will pay for your education. Create a trading journal, and analyze your losses ruthlessly. What emotional mistake did you make? Did you act on hope? Did you freeze in fear? Next, simplify your approach. Focus on identifying a major trend and learning to recognize key pivotal points. Develop a simple rules-based system for entering and exiting trades at these points. Most importantly, practice ruthless risk management. Define your loss before you enter every trade, and honor your stop loss without question. As Livermore's life shows, genius is nothing without discipline. The speculator who survives and thrives is the one who has mastered the art of capital preservation above all else. This is a path to longevity in the most fascinating game in the world.